All right, now we're going to run some numbers. We're going to compare the most common paths that people have to retirement. And in my case, I don't like the word retirement, so it'll be financial freedom. But for example, saving your way there, right? Or buying a rental, things of that nature. And then just doing apartment buildings as well. We're going to kind of show side by side how long each strategy really takes, what the income looks like, and what's actually scalable. Most people have never done this before. We're going to do it here in this next video. And hopefully you'll agree, multifamily isn't just faster, it's a completely different game. So grab your workbook, follow along, let's dive in. I want to start talking in this training about the fastest path to financial freedom because it's pretty clear that near everyone on this call wants financial freedom. And there's different ways to get there, right? And you probably have a particular path or you thought about a path. So I want to talk about the most common ways I've seen people get to early retirement. So this is now beyond the real estate investing strategy. This is like different ways to get to retirement. And so we're going to figure out what's the fastest path to financial freedom, but also not only that, but how long does it take? How long does each path take? Because you may or may not actually have done this kind of math before. Now, most people follow option one, which is to save enough to be able to retire. They do this by maxing out their 401ks, by rolling their savings into an equity and bond plan. And so let me ask you this. Who here has heard of the 4% rule? Type yes in the chat box. 4% rule, in case you haven't heard, is used by financial advisors to estimate how much money you need to comfortably retire. So it goes like this, right? So if you need $100,000 per year to retire, then you can only liquidate 4% of your assets, and that's $100,000 per year, and therefore you need $2.5 million in assets. Now that's a lot. That's a big number. I chatted this earlier, but the average savings of a 65-year-old family in the United States is like $179,000, excluding the equity in the house. Okay, they have some equity in the house, but they don't have $100,000, and that's the average. And so $2.5 million is a very large number, and the question is, how are you doing towards that number if you're pursuing this path? So if you Google compound interest calculator, if you just punch it into Google, you take the first one. This is the one that we actually found. And so if you look at this thing right now and you invest $50,000 per year, which is a lot. Okay, it's a lot. But let's say you could invest $50,000 a year, $4,200, and you can get an 8% average annual return, which is about the average for the stock market over the last 30 years. How many years do you think it would take you to get to $2.5 million? Like, it takes 19 years. So if you punch in the calculator, you put in 100,000. That's your initial investment, let's say, $4,200 a monthly contribution, 8% interest rate. And then the length of time here is 19, you get to $2.5 million, right? Isn't that wild? Like, really? If I said $50,000 a year for 19 years, I have $2.5 million, and now my living expenses can't exceed $100,000, right? And what if you're investing less than $50,000? Or let's say you want more than $100,000 per year. So it's going to take you longer to retire. And the average American doesn't stop working at 65. They're working past 65. They're going into consulting, whatever the case may be. Now, some of you might be thinking, okay, cool, that sucks. All right, I get it. Okay, but I have a better plan. I'm going to buy a single family rentals instead. So let's look at that. Let's look at option two, which is better. Okay, it's single family rentals, right? So let's say your freedom number is $10,000 per month. It seems to be the most common freedom number. It's $120,000 per year. And let's say you make good money, and you're able to save a good portion of what you make. And so your plan is to buy one rental per year. And the median purchase price of a single family home in the United States is $400,000. So let's say it's $400,000. Monthly cash flow is about $200. Wah, wah, wah. Not that great, but okay, it's okay. And the portfolio appreciates about 5% per year. I also chatted that. As real estate, it goes up between 3 and 6%. I'll go on the high side. And you're going to hold this for 5 years and then sell for a profit. Now, when you sell, there's 9% in sales codes, sales commissions and closing costs and things of that nature. Okay, now you can punch all this stuff into a spreadsheet, which I have done. Okay, so let's look at this stuff here, right? So your first year, $400,000, you got $2,400 in annual cash flow. And then by that, so let's say you're buying on January 1, so by the end of the year, it's gone up by $20,000. So now your portfolio value is worth $420,000, which is super cool. And you're not selling anything, as it doesn't matter. Now, next year, I'm going to do it again. I'm going to buy another $400,000, okay? And now I have a total of $4,800 in cash flow. And my portfolio at the end of the year is now has appreciated by another $41,000, $20,000 from the first one, slightly more, $21,000, and $20,000 from the house I bought in January 1. So now my portfolio value is $861,000. So Kind of see how this is going? So I'm just going to do this again and just kind of add it all up. So I'm going to do this again and again and again. All right, so at the end of the day, in year 5, I'm going to start to sell what I bought in year 1. And I paid $400,000 for it. Now it's worth $510,000, which is super cool. But I have $45,000 in sales costs, 9%, also chatted debt. And so you're actually left with a $65,000 profit in addition to the cash flows, et cetera, here. And then you also have some equity here. So you can see here the portfolio value is 2.3. And I bought $2 million worth of real estate, and it's now worth 2.3. So I am building equity. It's super cool. But if you look at the income down here in year 1, year 2, year 3, I'm trying to cover $120,000 nut. I'm nowhere near that. Even when I start selling in year 5, I'm not near that. Now let's look at year 6. I'm starting to sell stuff from year 2 and 3 and year 4, and I'm still buying, by the way. I'm still buying. So you can see here that my money coming in year 5, starting in year 5, is essentially $80,000 from cash flows and previous sales, okay? So the problem is the strategy, if you do the math, you're still falling short of your number. You're never going to get there. Now, you can maybe buy 2. You can buy 2 if you have that kind of money, okay? You can buy 2 and accelerate that, but my goodness, right? It takes a long time. It's just, and most people I've talked to have never actually sat down and done the math with this. So go ahead and for yourself, do this math, right? Do this math and sit down. If you're on a track of flipping or rentals or short-term rentals, or whatever the case, write down the math. How long is it going to take you? Now let's do 3. Okay, 3 is actually scaling with multifamily. And so your plan here, in this particular plan, is that you're going to buy one $4 million property per year. Now we talked about it in part 1. You may need help to do this, and you may need a partner. Okay, we'll talk about how to close your first large multifamily deal in part 3. Okay, also we're going to talk about how to close your first large multifamily deal in a later training. So make sure you join us for that as well. What I'm trying to do is show you how this strategy compares to the other 2 that everyone else follows. So, okay, so your plan is to syndicate one $4 million property in the next 12 months. And then you plan to hold that property for 5 years. And then you're going to syndicate one property that's slightly larger than the first, right? Because if you can do it one time, then you can probably do a second time and maybe just make it a little bigger. So let's just compare the numbers. Let's just look at the first one. Just the first one alone. Okay, the first one alone is that you have $120,000 in acquisition fees, which you talked about in the previous training. You got $12,000 in asset management fees and about $26,000 in cash flow. So your total compensation is $160,000, which is above your $120,000 hurdle, but you're probably going to have a partner. Okay, you're probably going to have a partner. So if you're a deal finder, you're probably going to have a capital raising partner. If you're a capital raising partner, you're going to have a deal finder partner. Typically, it's what happens. Okay, so this is pretty cool, right? Now, if I go to year 2 and I buy, instead of $4 million in real estate, I buy $5 million, you can see here now, I'm getting another acquisition fee. I'm now getting the asset managements from 2 properties, and I'm getting the cash flows from 2 properties. And now it's starting to come together, right? Now it's $250,000. Even if I divide it by 2, it's now $120,000. And this is why a lot of people can literally become financially free after 1 to 2 deals, depending on how they structure the deal. Can you guys see that? Like, type yes in the chat box if you can see that. And this is why this vehicle is so strong and so quick in getting people out of whatever they're doing because of this thing. Now, again, we haven't really talked about, well, how exactly am I going to do that? Because we're going to talk about that in a later training. We're going to go very deep on how to analyze deals, how to find deals, how to talk to brokers. We're going to spend the majority of the time on how to raise capital. Okay, but people are doing this. Okay, we've helped hundreds of people do this, and people do this. I'm just showing you what's possible. And again, while none of these numbers are guaranteed, they're not unusual at all. And it's not necessarily due to the genius of the person. You know, they're all working hard getting stuff done, but it's really the vehicle that's so powerful. And it doesn't end there, because if I keep doing this after 5 years, again, buying slightly more real estate, if I can buy $5 million in real estate, I can probably buy $6 million in real estate. If I can buy $6 million, I can probably buy $7 million in real estate, okay? Most people who get in this business, they don't scale like this. They scale, they buy $4 million, $6 million, $10 million, $15 million, $20 million. But I'm just giving you something that you can possibly associate with. And so you can see here the overall compensation, you know, per year is in the hundreds of thousands of dollars. And in 5 years, you're making $2.2 million off of acquisition fees, asset management fees, cash flows. And again, in year 5, you're starting to sell stuff from year 1, which is not like $50,000, but actually at $240,000. And if I just play this thing forward, and I didn't go to year 10, I stopped at year 6. So if I stop at year 6 and I stop buying stuff, you're making $6.6 million of income. So the vehicle is very powerful. And you can see here, it takes 1 to 2 years, is the point I'm trying to make. It takes 1 and 2 years to actually be able to quit your job. And you just compare the two, right? If you buy one $400,000 rental per year, you can make $100,000 after 5 years. And in comparison, you're making $520,000 years. You're making $500,000 after 10 years. So you're spending 10 years making $500,000. Or you can syndicate one $4 million property per year and make 2.2 in the first 5 years and over $6 million over 10 years. The numbers are completely different. Now, let me show you that I'm just not making these numbers up. Like, we actually got these numbers from studying like 24 deals that we've done, our students have done, and we kind of created averages and rules of thumb, so we kind of know, hey, based on how much you're purchasing, what are those numbers, okay? But I'm going to show you just even a more, that was 2 years ago. Oh, that was 4 years ago. That was 6 years ago, okay? So I did it for our most recent deal. This is Waverly Manor Apartments. It was a 61 unit in Norcross, Georgia, just out of Atlanta. This is what we closed. This was a Nighthawk equity deal. So I'm going to show you some real deal returns. So what I'm going to show you here, I'm going to show you what we call the syndicated deal analyzer, or SDA for short. It's our analysis tool. You can Google it, syndicated deal analyzer. You can buy it for like $150. It's the most widely used analysis tool on the planet right now. We're going to spend a lot of time in it and in later training when we talk about deal analysis. So here's the SDA for Waverly Manor. What I want to show you, there's different tabs here. I don't want to overwhelm you, but there's a returns tab. The returns tab shows you what the returns are for the manager. But the manager basically is the general partner, right? So you can see here, the distribution from cash flows is up here. You see how it goes up a little bit because you're doing a value add, you're renovating units, you're slowly increasing rents. So you get some distributions because remember, we get sweat equity as general partners, we get sweat equity. So that's the first line here. Okay, then we have the acquisition fee. This is what is this? This is just so you know, this is a $9.2 million purchase. Okay, so you're getting a $267,000 acquisition fee. Then you're getting an asset management fee. You can see here it goes up slightly because the income goes up slightly. It's a percentage of income. Then there's something called a capital transaction fee, which is when you sell at the end, it's 1.5% of the price. We talked about that in an earlier training. So when you sell, you get 1.5% of the sales price. And then, of course, there's the net profits from sale at the end, which is $922,000 for the general partners. So you add that's right. You also get construction management fee. We talked about that. Construction project is going to take 2 years. So the construction budget is $600,000. So 5% of that, what is the construction cost? It's over here somewhere. Anyways, that's $60,000 in fees. And then you have a marketing fee, which I talked about last time as well. So you see here the total. You see all these fees, the total. Now I'm adjusting it for $4 million just so you can see like apples to apples. You can see here it's $856. And now what I told you earlier, it's $620,000, so it's higher. Why is it higher? Well, it's a little higher because in my $620,000, I don't include construction management fees and I don't include a marketing fee, and I did not include a capital transaction fee. Okay, so if I strip all that stuff out, this number is much closer to $620. Okay, so this is a real live deal that we did. That's about twice the size, as big as a $4 million deal, but you can see here how these numbers work, and they tend to be true with deal after deal, obviously being average. So we're not making this stuff up. These are kind of real numbers. And so really, this is why I'm convinced that multifamily is indeed the fastest path to financial freedom. And this business is extremely lucrative, and you can scale it quickly so you can exit whatever you're doing in 1 to 2 years. Okay? The only thing you got to do is you got to figure out how to do it. We're going to talk about part 1 in this training, which is the scaling mindset. You need a scaling mindset before I talk about any kind of tactics in a later training. If you don't understand or don't know the scaling mindset, all that stuff is going to be for naught. So I have to start with the scaling mindset, which I'm going to do here in just a second. I just want to build your plan going, oh my gosh, these numbers work. Again, we're going to talk about how to do this in the rest of this training. And so this is what Bruce Frazier did. He closed his first deal 9 months after working with us. It was 130 plus units, and it was $8,000 in monthly income, which is super cool. And then another 6 months later, he did 80 units. And yet he did 110 units first and then 80 units. So after those 3 deals, he had $15,000 in monthly income, which was awesome. And then 3 years later, he sold his first apartment, that 130 plus unit. He sold it for like $1 million profit for him personally. Now, again, it was a rising market. Things went right. He bought right. I'm just saying it's a big number. Today, he owns over 2,000 units because he's been able to scale with multifamily. He was able to quit whatever he was doing in 1 to 2 years. Okay, so now you've seen it, not just the strategy, but the numbers. And for a lot of people, this is the first time they've done that, and things start to click. So I hope you'll stop trying to save your way to financial freedom, stop investing in single family houses, and pursue a different path with apartment buildings. Now, the question is, if multifamily is so powerful, why doesn't everyone do it? In the next video, we're going to answer that, and I'll walk you through the real reason most investors actually fail to scale, even if they know about multifamily. And it's not about deals or money or how smart you are. It starts with mindset. So I'm going to share with how I struggled with myself and how one shift that I did unlocked really everything for me. And then that same shift also worked for hundreds of our students. So don't stop here. Also, book a call with my team if you're ready to take the next step, and then let's watch that next video.